Next question. H Limited agrees to buy the business of B Limited. So H Limited is acquiring company and B Limited is target company. Effective from April 1st, 2020, the summarized balance sheet of H Limited and B Limited as on 31st of March 2020 are as follows. So balance sheet is provided for both the companies on a specific date. Balance sheet, in that the figures are given in crores of rupees. For H Limited, we have been given the equity share capital of 350 crore. Reserves and surplus is 950 crore. So the total is 1300 crore. For B Limited, it is 6.5 crore, 25 crore and 31.5 crore. Net fixed asset 220 crore. Net current assets is 1020 and deferred tax assets have been given to us. H Limited proposes to buy out B Limited. So H Limited is considering to acquire B Limited, and following information is provided to you as a part of the scheme of buying. First, weighted average post-tax maintainable profit of H Limited and B Limited for the last 4 years are rupees 300 crore and rupees 10 crore respectively. Both the companies envisage a capitalization rate of 8%. H Limited has contingent liability of rupees 300 crore as on 31st of March 2020. H Limited is going to issue shares of 100 rupees each to shareholders of B Limited in terms of the exchange ratio as arrived on fair value basis. It has been given that please consider weight of 1 and 3 for value of the shares arrived on net asset basis and earning capitalization method respectively for both H Limited and B Limited. You are required to arrive at value of the shares of both H Limited and B Limited as under based on net asset value method, earning capitalization method. Exchange ratio of the shares of H Limited to be issued to shareholders of B Limited on a fair value basis, taking into consideration the assumption mentioned in point number 4 above. I request all of you to go through the question, please. Now friends, over here we understand that there is a question of the merger along with the valuation. The question is providing the information that you are required to value both the companies using net asset method, using earning capitalization method. So there are two bases by which you are required to do the valuation. First is the net asset method. In that it is very simple. Total assets minus total liabilities. So over here it is an amount of rupees 350 plus 950, that is 1300 crore. 6.25 plus 25, that is 31.5 crore. However, there is one important point. The question is providing the information over here that H Limited is having a contingent liability of rupees 300 crore. Now what to do about this contingent liability? For that, you have a choice. Either you may deduct it or you may not deduct it. Whatever the kind of like the working that you do, for that say you just have to put an assumption. Let's say this is the assumption that I have made for the purpose of making calculation of answer. Either of the working is acceptable from examination point of view. That is the way we are required to make the computation of the net assets, that is in the first part of the question. In second part of the question, we have to value both the companies using earning capitalization method. It means that we are required to compute the present value of the future earning. We have been provided with the information that what is the future earning of both the companies. It is an amount of rupees 300 crore and it is 10 crore. Dear students, over here, they have made the projection of this earning taking into account the weighted average results of the last 4 years. This information about the 4 years is of no use to us. In a simple way, we understand something like this. If at all we make investment of 100 rupees, we require income of rupees 8. Over here, earning is an amount of 300 crore. So, for income of rupees 300 crore, this is the investment that you are ready to make. And that is given a name as earning capitalization method, that is present value of the future earning. So it is 300 crore into 100 divided by 8. So it is 300 crore divided by 0.08. That comes to 3750 crore. This is the way we are required to do the valuation of H Ltd, and similarly we are required to do valuation of the B Ltd. In that the future earning is provided to us an amount of 10 crore. So present value of this 10 crore is the valuation of the target company using earning capitalization method. So friends, what we have done, we have made the valuation of H Ltd, we have done valuation of B Ltd. Using the net asset method, using the earning capitalization method. Then we will make the computation of the same on the per share basis, and that is going to be useful for calculation of the exchange ratio. For calculation of the exchange ratio, they have provided that say we are going to place a weight of 1 and 3. What does it mean? It is 25% and 75%. So the weights are 0.25, 0.75, exchange ratio by one method, exchange ratio by the second method, and then we will make the computation of the simple weighted average. And simple weighted average is what we understand is the exchange ratio for the purpose of acquisition. So I request all of you to write down answer along with me. First point, in this question, we have to calculate exchange ratio for merger along with valuation. Second point, earning capitalization method means present value of future earning. Full stop. It is calculated as under earning divided by K minus G. Dear students, the term G stands for the growth rate. So if growth rate information is given, it is supposed to be taken into account. If it is not given, we have to ignore it. Earning is of course at the end of the year. So K stands for cost of capital and G stands for the growth rate. Third point, in case of net asset method, comma, we may deduct contingent liability, comma, we may not. Either of the answer is acceptable. Full stop. Right on answer. Calculation of value per share of both the companies based on both the methods. So we have been provided with the information about H Limited and B Limited. For both of them, we are required to calculate the answer using earning capitalization method and using net asset method. So we'll make the calculation like this. In case of the net asset method, this is the net asset. In a way, that's the gross assets. This is the gross assets. There are no liabilities. The only contingent liability will be deducted for H Limited. So we can write the answer like this. Net asset of H Limited is 1300 crore minus contingent liability of 300 crore, that comes to 1000 crore. For B Limited, it is 31.5 crore. The same will be divided with number of equity shares. As far as H Limited is concerned, it is 350 divided by 100, 3.5, and 6.5 divided by 10, that is 0.65. So number of equity shares 350 crore divided by 100. that comes to 3.5 crore. And for B Limited it is 6.5 crore divided by 10, that comes to 0.65 crore. So net asset divided by number of equity shares will give the net asset per share. So 1000 divided by 3.5, so 285.71. It is 1000 crore divided by 3.5 crore. For the next one, it is 31.5 crore divided by 0.65 crore. That is 48.46. This is the way net asset per share. Now, in case of earning capitalization method, language of the question is extremely clear. The weighted average post-tax maintainable profit of H Limited and B Limited for the last 4 years. See, maintainable profit. What does the term maintainable profit mean? It means that say in future we are expecting this amount of the profit to remain, 300 crore and 10 crore respectively. So this will give us the present value of the future earning. So it is present value of future earning. In that we will be having earning divided by cost of capital. Okay. Now for H Limited, so the earning is an amount of 300 crore divided by 0.08. It is 3750 crore. And for the next one, it is 10 crore divided by 0.08. That comes to 125 crore. So this is the present value of the future earning. The same will be divided with the number of shares. So we understand that it is price per share. It is 3750 crore divided by number of equity shares. It is 3.5 crore. For the next one, it is 125 crore divided by 0.65 crore. That is the way the price per share can be calculated. 1071.43. 125 divided by 0.65. 192.31. This is the way the price per share can be found. Now I request all of you to make the calculation of the exchange ratio on your own and put your answer in the chat box. So let us answer calculation of exchange ratio. In that, column number 1 is basis, column number 2 is weight, column number 3 is exchange ratio, weight into exchange ratio. It has been given that say the 1 is the weight to be given for net asset. So for net asset it is 1 divided by 1 plus 3. And the next is the earning capitalization method. In that it is 3 divided by 1 plus 3. So this is 0.25. This is 0.75. Exchange ratio based on the net asset basis. 48.46 divided by 285.71. And for the earning it is 192.31 divided by 1071.43. That comes to 0.1795. 48.46 upon 285.71. So 0.1696. Now it is 0.25 into 0.1696. 0.75 into 0.1795. So 0.0424. 0.1346. So 0.1770. This is the weighted average exchange ratio. And this is what's the exchange ratio for the purpose of merger. So exchange ratio will be found like this. The bases are net assets and earning. Weights are provided as 0.25 and 0.75. That is 25% weight is given to the first one and 75% to the second one. So 1 divided by 1 plus 3 and 3 divided by 1 plus 3. Multiplied with the respective exchange ratio. It is the value of target company divided by value of acquiring company. Value of target company upon value of acquiring company. And that is the way the weighted average exchange ratio is found. So finally we understand that we are required to make the computation of the value of share, and based on that the exchange ratio is required to be found. The new point that we have over here is calculation of the present value of the future earning. The new point that we have over here is calculation of the net assets considering the contingent liability.